You've been told the Federal Reserve controls your interest rates. That's a lie. Your mortgage, your car loan, and your 401k are all tied to oil-rich nations in the Middle East. America's economy depends on a deal most people never knew existed. None of it is secret, most of it is on the public record. Almost none of it was ever put to you. Chapter 1. The 2026 Mortgage Spike. In March 2026, the average 30-year mortgage rate climbed by 13 basis points. It's the biggest weekly jump in nearly a year. Eventually, it hit its highest level since September 2025. Just 3 weeks later, rates surged again, this time by 34 basis points. Mortgage applications fell 10.5% that same week. Refinancing fell off a cliff. It wasn't for the usual reasons. The Federal Reserve hadn't raised rates. Inflation data hadn't suddenly exploded. Instead, war tensions abroad were pushing Treasury yields up. Mortgage rates were dragged along with it. So how does conflict on the other side of the world change the cost of buying a house in America? Behind the scenes, a small number of foreign governments hold enormous amounts of U.S. debt. When one of them suddenly needs cash, there is a simple way to get it: sell treasuries. When a major holder starts selling into a volatile market, treasury prices fall and yields rise. American mortgage rates are built on top of those yields. When long-term bond yields climb, 30-year mortgage rates usually climb with them. Banks price home loans off of that bond and then add their own cut on top. None of this is hidden, it's just rarely said out loud. The numbers behind it are bigger than most people realize. The Federal Reserve Bank of Kansas City estimated that a single month of roughly $141 billion in foreign treasury selling could push U.S. yields up by about 57 basis points. Other estimates range from 25 to 100 basis points. A separate study in the Journal of International Economics puts the impact of a $100 billion sale at around 100 basis points within a month. Put that on a median new American home today. A 50 basis point jump adds about $130 a month to your mortgage, every month for 30 years. A 100 basis point move roughly doubles that, north of $260 a month. Over the life of that loan, it adds up to tens of thousands of dollars, all of it paid out of one family's future. And the pain does not stop there. Home equity is the biggest pile of wealth most middle-class families ever touch, and when their rates shift, it starts to chip away at it. The house stops rising in value, while the cost of keeping it climbs. That is wealth thinning in slow motion. Higher rates also halt new construction and renovations. Projects get delayed, jobs on framing crews, electricians, and contractors disappear. The slowdown doesn't stay in housing, it spreads outward. Car loans get more expensive, student debt becomes harder to refinance. Even small business credit lines start tightening in towns that have nothing to do with global bond markets. All from one shift in a distant market. One thing can send a shockwave through the entire system before most people even realize anything has changed. Chapter 2. The Invisible Pawn Shop. The Fed uses a system called the FEMA Repo Facility. FEMA, or FIMA, stands for Foreign and International Monetary Authorities. Let's say a foreign central bank owns U.S. treasuries and suddenly needs dollars. It can bring those bonds to the Fed, hand them over as collateral, and then walk away with cash. It's a short-term deal. It gets bonds back when the trade is reversed. Essentially, it's a pawn shop for entire countries. But it was never meant to be a permanent system. The Fed set up a temporary FEMA repo facility on March 31, 2020 during the COVID pandemic. It was supposed to run for at least 6 months. It was extended again and again. On July 28, 2021, the Fed made it a standing facility. There was no debate or vote, it just became a thing. The pricing was set deliberately high, 25 basis points over the interest rate on excess reserves. That rate is on purpose. It sits above private market rates when conditions are calm. So nobody uses the Fed's counter when markets are healthy. The open market is cheaper and easier to deal with. A central bank only uses it when selling would be worse than paying the Fed's markup. In other words, it only gets used when doing anything else would make things worse. For years, the Fed has been fighting inflation and making loans harder and pricier. But at the same time, the Fed is ready to hand dollars to foreign central banks. One move squeezes the American borrower. The other ensures that if a foreign holder needs help, there is always a backstop waiting. Critics say it creates a death loop. When a market knows there's always a safety net for its biggest players, pricing stops being honest. Price discovery is the whole point of a market. It's how everyone learns what a thing is truly worth. Markets don't move on just data. They move on what people believe will happen when things break. And that's the problem. Emergency tools are supposed to be the backup, the last resort. They only exist for rare moments of stress. But if they keep getting used, rare stops meaning rare, and it becomes a part of the system. FEMA became necessary because the normal buyers of U.S. debt stopped doing their job as reliably as they once did. But the warning signs were there. Chapter 3. The warning nobody watched. On September 17, 2019, the repo rate, the rate that banks pay to borrow cash overnight against safe government bonds, suddenly spiked. It went from about 2.4% to over 5% in a single day. At one point, it briefly touched the double digits. For a market that rarely moves 20 basis points in a session, that's a warning sign, and nothing big had happened. The cause was boring. Corporate tax payments drained cash out of the system at the same moment that a large Treasury settlement pulled even more liquidity away. Roughly $120 billion vanished from available reserves in a single day. The institutions that normally smooth these gaps didn't step in fast enough. Not because they were in trouble, but because the rules and incentives after 2008 made them more cautious about doing so. The New York Fed responded within hours. It injected $75 billion and repeated the operation every day for the rest of the week. This is where the Fed drew a line. Cash drained out in predictable ways: tax payments, Treasury settlements, normal events. But there wasn't enough of a buffer left in the system to absorb them. Nobody in charge could confidently say where the safe level actually was anymore. So 2 years later, in July 2021, the Fed made it permanent. It turned its emergency repo actions into a standing repo facility for U.S. banks. This was a standing promise to step in and lend cash whenever private markets wouldn't. It was the same day it created the FEMA facility. One domestic, one global, both built for the same reason, to make sure liquidity stress could never again spike the system like it did in 2019. And this became the template for everything that followed. Chapter 4. The Japan Pivot. For a long time, Japanese institutions were among the steadiest holders of American government debt. They were reliable enough that markets treated them as part of the furniture. The thing pulling Japanese money across the Pacific was a trade called the carry trade. Japanese rates sat near zero for years. Investors could borrow yen for almost nothing, convert it to dollars, and then buy higher-yielding U.S. assets. The difference became the profit. For years, huge amounts of capital flowed through that single trade. It didn't feel like speculation in the usual sense. Money moved so consistently it stopped looking like movement at all. It worked like a hidden stabilizer under the whole treasury market. And that all changed in 2025. The Bank of Japan stepped away from its long era of super loose policy. It raised its policy rate in stages. By December 2025, that rate sat at 0.75%, the highest in 3 decades. The increment looked small, but its effect was not. A carry trade only prints money while the borrowed money is free. The moment the yen stopped being free, the gap that justified the trade started to close. Even worse for Washington, Japanese bond yields were rising at home, above 2%. Japanese investors suddenly had a reason to bring their money back. They could earn a safe return in their own currency. Money that had flowed out for a generation began to turn around. Japan's pullback arrived while U.S. debt issuance was setting records. At that exact moment, Washington needed to sell more debt than ever, and one of its most reliable buyers started stepping back. That doesn't trigger an instant crisis, but it changes the balance underneath the system. Because when a borrower suddenly needs more money while a longtime lender buys less, the stress has to go somewhere. The foreign slowdown wasn't even the full problem. While that cushion was thinning overseas, another pressure point was quietly building inside the United States itself, one large enough to matter on its own. Chapter 5. The $1 trillion maturity wall. Washington is not the only borrower in America living or dying by the refinancing window. Underneath the federal numbers sits a second debt pile. Most people never think about it until it lands on them: commercial real estate. From the office block downtown to the strip mall off the highway, almost none of it is financed with loans that pay themselves off over time. Those loans come due in full. Nearly $1 trillion in property loans were scheduled to come due in 2025 alone. Hundreds of billions more were stacked right behind them in 2026. That means well over $1.5 trillion in debt suddenly has to be refinanced into a completely different world. A building financed years ago at 3% now has to roll into a loan that costs dramatically more, while the building itself may be worth dramatically less. For many properties, there isn't enough income left to make the numbers work anymore. So lenders lean on a move called extend and pretend. And it's exactly what it sounds like. Banks extend loans and push the deadlines out for another year or two. They avoid locking in the loss today, and they hope conditions improve before the problem comes back around. Individually, every step sounds reasonable, but across the entire system, those delays start piling on top of each other. A refinancing wave that large, hitting that fast, is enormous. It's a debt on the scale of an entire mid-sized country's economy suddenly needing new terms all at once. Except this isn't some distant sovereign crisis, it's American real estate. Much of that debt was written in a completely different era when rates were low and property values were far higher than they are now. Some sectors got hit harder than others. 35% of hotel mortgages and 24% of office mortgages came due in that single year. Offices have an extra problem. The working world stopped using them during the COVID pandemic, and working from home became the new reality. Fewer workers came back and the buildings emptied out, so naturally their values fell. Now, the loans are coming due against properties worth less than when the debt was originally issued. Hotels have a similar problem. Their revenue swings with travel demand and conference budgets. Both shrank. That pressure does not stay inside of real estate. It moves directly into the banking system, especially smaller regional and community banks. They tend to hold huge amounts of commercial property debt on their books, and those are the same banks many small businesses rely on every day. A bank carrying quietly stressed property loans becomes more cautious. Lending tightens, small businesses struggle to expand. First-time home buyers get squeezed harder. This is where the pieces start connecting. Earlier, foreign demand for U.S. debt began thinning out. Now domestic credit is tightening too. Two separate pressure points start pushing against each other. And because the losses haven't fully surfaced yet, the system enters a strange state. Everyone knows the stress exists, but nobody wants to be the first to fully price it in. Banks extend the loan or rewrite the terms. They can give the borrower more time. Technically, the loan can still look current on paper because payments are still being made under the new agreement. But the losses don't vanish. They just sit there, quietly accumulating until the system runs out of room to keep postponing them. Chapter 6. The Dollar Liquidity Squeeze. The Gulf runs on a steady current of American currency. Oil is priced in dollars. Export money returns in dollars. Sovereign wealth funds are all measured in dollars. When the Iran war broke out in late February 2026, the conflict had a global impact. The closure of the Strait of Hormuz choked off the flow of roughly a fifth of the world's oil. Oil prices rose and inflation expectations rose with them. Treasury yields and mortgage rates followed. As instability spread through the region, governments across the Gulf started pulling harder on dollar liquidity. These countries are usually portrayed as the lenders, the cash-rich powers buying skyscrapers, sports teams, and stakes in companies all over the world. But when dollar funding tightens, even they can feel the effects. The countries people imagine as financially untouchable still depend on the same Federal Reserve mechanics as everyone else. When the pressure rises, they need dollar access too. Fast, which means the image of total independence was never quite real. It only looked solid while dollar liquidity was easy. And that's when the foreign banks face a hard choice. They either sell a huge pile of treasuries into an already stressed market, but that creates its own problem immediately. Selling pushes bonds down and yields up, which means that the value of the bonds you still own also falls. You solve the cash problem by damaging your own balance sheet. So most don't want to do that unless they absolutely have to, which means they use the Fed's dollar backstops instead. They borrow dollars, post collateral, and avoid dumping bonds into the market. And that decision can ripple all the way into American households. If enough treasuries hit the market all at once, yields rise, mortgage rates rise with them. Retirement portfolios get hit too. One liquidity decision overseas can change the monthly payment on a house thousands of miles away. For the foreign banks, it makes sense. Without swap lines or repo facilities, they have no choice except to liquidate treasuries into the open market. And that kind of forced selling can spiral fast, driving yields sharply higher and destabilizing everything tied to them. The backstops exist to stop that chain reaction before it starts, and technically, these arrangements are structured to protect the Fed from direct currency losses. So this isn't a simple bailout in the way that people imagine, but the broader shift is still real, and the repeated use becomes the normal and then is baked into the system. Chapter 7. Who actually holds the debt now? You might imagine a dollar swap taking place in smoky back rooms in Washington. An oil-rich Gulf state storms into Washington, makes demands, and threatens to dump treasuries unless it gets what it wants. That's not how it works. When swap line discussions happen, they're not ultimatums, they're precautions. Countries with enormous reserves want reassurance that if markets freeze or dollar funding tightens, they still have access to liquidity. Kuwait's U.S. Treasury holdings have climbed to records near $66 billion. UAE holdings are in the tens of billions and growing, backed by reserves far larger than that. So this wasn't a case of bankrupt countries begging for rescue. The real purpose of these arrangements isn't necessarily to save the creditor, it's to stabilize the treasury market itself. Because the danger isn't just that a large holder loses money, the danger is that a large holder suddenly becomes a forced seller in a market already struggling. The word precautionary is doing a lot of heavy lifting. It's less about emergency aid and more about keeping major creditors calm enough to keep holding debt. That leaves the United States in an uncomfortable position. If policymakers don't reassure major holders, the risk of panic selling rises. But if policymakers do build permanent reassurance mechanisms, the dependence becomes more structural. The reserve issuer starts managing the conditions under which its creditors remain comfortably financing it. Neither option is especially clean. And once one major holder starts becoming more cautious, the others notice. That's how financial behavior spreads. If one large player starts hedging, everyone else starts asking whether they should too. And that's important because the treasury market rests on a global assumption that has existed for generations. U.S. government debt is supposed to be the safe asset, the foundation underneath everything else. But foundations rarely crack all at once. Usually confidence erodes gradually. For decades, foreign demand under American debt came mostly from allied central banks. They buy for strategic and monetary reasons. They don't panic sell because one quarter went badly. Now that's changed. In 2024, foreign private investors overtook foreign governments as the largest overseas holders of U.S. treasuries. And private capital behaves very differently. These aren't institutions built to sit still for geopolitical stability or long-term reserve management. Many are asset managers, hedge funds, and leveraged traders running complex treasury and repo trades through global financial networks. Their job is to move when the conditions change, which means the market swapped part of its shock absorber for something much more reactive. Chapter 8. The Great Dollar Backstop. The Federal Reserve has taken on a role it was not originally designed for. It's now a standing source of dollars not only for American banks, but it's also a standing source of dollars for the global dollar system, foreign central banks included. People can argue about whether the Fed expanding its role in global dollar support is good or a form of overreach, but the expansion has happened, and most people aren't aware of how far it's gone. The Fed's total commitment to rescuing the system since 2008 tops $29 trillion. That's enough to pay off the vast majority of the United States national debt in a single transaction. Not $1 of that built a road, funded a school, or made the economy more productive. The purpose was narrower: keep a stretched system from having to recognize its flaws. Every dollar of it bought time, none of it bought a fix. What has thinned across all of this is not money but independence. American prosperity was once close to self-funding because the world wanted the debt freely, and that has weakened. More creditors now rely on official backstops as part of staying in the market, not as an exception, but as something assumed will be there if selling pressure appears. At the same time, the holder base has become faster moving and more sensitive to changes in rates and liquidity conditions. That shift made it harder to rely on private demand alone to absorb the stress. The Fed's backstop is no longer temporary. It's no longer small. The system now relies on two things that cannot be taken for granted: the continued willingness of large holders to hold U.S. debt and the standing presence of central bank support when they do not. And that is not a prediction of collapse, it's a description of the conditions already sitting in the system. And conditions like that don't stay theoretical forever. But let's say the worst does happen. How will the average American cope with a worthless dollar, and who will be left picking up the pieces? Find out in What If the U.S. Economy Crashes, or watch this video.
Want a professional logo or high-quality AI art? I design elite brand identities fast. DM me right now to place your order.